Hey everyone, and welcome to The Explainer. Today, we're going to dismantle a really massive myth in modern finance. For years, we've been fed a very specific story about poverty, capital, and lending, right? We've basically been told that if we want to give the unbankable poor access to fast cash, well, we just have to accept astronomical interest rates and predatory conditions. But today, using evidence straight out of a comprehensive review of Islamic social finance reform, we're going to prove that narrative completely wrong. We're going to look at a fully functional blueprint that disrupts predatory lending entirely by replacing extraction with empowerment. Okay, let's dive into this. If you take a look at the lower income economy today, especially in places like Indonesia, there is a massive crisis going on with predatory digital lending. It's often referred to locally as pinjal. Now, the main argument you'll hear from defenders of these super high interest digital loans is that they're basically a necessary evil. The reasoning goes kind of like this. The poor urgently need fast capital. Formal banks absolutely will not touch them because they don't have collateral or a credit score. So nobody else is going to provide the money. Therefore, no matter how devastating those interest rates are, it's argued to be their only option. But is it, really? The contrast between these two models is just stark. On one side, predatory digital lending does offer fast capital, sure, but its core mechanism relies on wealth extraction, massive interest rates, and trapping borrowers in a really vicious debt cycle. But on the other side, we have the Islamic Social Finance, or ISF model. It also provides fast capital, but its core goal is wealth transformation. It operates on zero interest and actively works toward debt liberation. Now, you might be sitting there thinking the right side sounds a bit like a utopian theory. But the research we're unpacking today proves that this ISF model isn't just some nice idea. It is a fully scalable, empirically proven reality.
All right, moving to Section 1, Akhuwat Zero Interest Scaled.
Now, what's really interesting about this slide is this staggering number right here, over 850 million US dollars. To prove this isn't just theory, we're looking at a concrete proof of concept thriving right now in Pakistan, which represents the strongest empirical evidence of a structural community-based alternative. That is the amount of money dispersed in loans by the Akhuwat Foundation. And here is the truly disruptive part. Are you ready? Every single one of those dollars was loaned out at exactly 0% interest. Literally none. It operates entirely on the Islamic principle of Qard Hasan, which basically means benevolent lending.
Let's break down exactly what Akhuwat has achieved since Dr. Muhammad Amjad Saqib founded it back in 2001. They've served 6 million families through this massive network of over 800 branches spanning more than 1,500 cities. And 92% of these zero-interest loans go directly to family enterprises. So you're probably wondering, how on earth do they survive without complex risk algorithms or traditional credit scores? Well, they do it by leveraging pre-existing communal trust. Disbursements happen in local mosques during a community gathering, which naturally creates this incredible sense of social accountability. And one of their absolute best innovations is something they call the Liberation Loan. This is a specific loan explicitly designed with a single purpose: to help borrowers pay off high-interest informal users. It essentially buys them out of that predatory debt cycle, allowing them to finally start fresh and actually build wealth instead of just scraping by day to day.
The whole philosophy behind this incredible success is perfectly captured by the founder, Dr. Saqib. He says poverty is not just about not having money. Poverty is when you have no friends, no status, no rights. With the loan, we erase economic poverty. With the communal process, we erase social poverty. This is absolutely vital to understand. Akhuwat doesn't just shoot money out through some cold, indifferent digital app. By utilizing the community to verify eligibility and support the borrower, they are actively rebuilding the social fabric that predatory debt destroys. Section 2, the 4 pillars of ISF reform. So the crucial point is, how do we take the brilliant DNA of something like Akhuwat and turn it into a systemic blueprint that can be replicated across entire nations? Well, the research identifies 4 distinct institutional reform models. I want you to think of these as 4 essential puzzle pieces that interlock to build a really robust financial engine. Cluster A is that community-based 0% lending, which gives us foundational trust. Cluster B is blended microfinance, acting as a buffer to absorb risk. Cluster C integrates zakāh and waqf to build long-term infrastructure. And Cluster D, that brings in the digitization to achieve massive scale. Let's look a little closer at how each of these gears turns the larger machine to disrupt the predatory cycle. We'll start with Cluster A, the community-based Qard Hasan. This is truly the heart of the system, just like the Akhuwat model we were just looking at.
It provides exploitation-free capital access by relying on social solidarity and pre-existing networks. Think local mosques or precentrons, which are Islamic boarding schools. These trusted community centers become the focal point of finance. But the literature is really clear on its primary limitation. A heart needs blood to pump, right? To scale effectively without collapsing, this model absolutely requires a highly sustainable source of funding. It needs a strong revolving fund so the capital doesn't just suddenly dry up when the community needs it the most.
And that leads us perfectly into Cluster B, the blended microfinance model, which introduces a brilliant mechanism called first loss capital. Imagine this as a structural safety net. By using zakāh, which is almsgiving, and waqf, which refers to endowments, as the first loss tranche to absorb any initial loan defaults, formal Islamic microfinance institutions finally get the confidence to lend to those unbankable populations. This is incredibly revolutionary for formal banking systems that traditionally demand hard collateral before they even open the door for you. It shifts charity away from just being a one-time handout and instead uses it as a highly sophisticated financial shield to unlock serious commercial financing for the poorest demographics. Next up is Cluster C, the zakāh waqf integration. If Cluster A is the heart, Cluster C is the engine driving long-term sustainability. This model focuses heavily on building deep economic infrastructure through a highly efficient division of roles. The literature highlights practical examples like Rumah Gomilion, Indonesia, where zakāh is utilized to build human capital, so funding critical skills training, education, and providing working capital. Meanwhile, waqf is used to build the physical capital, meaning the actual buildings, the land, and the educational infrastructure itself. It's like the perfect 1-2 punch. When you put them together, you have a perfectly coordinated ecosystem tackling both the hardware and the software of poverty alleviation. Finally, we have Cluster D, ISF digitalization. These are the wings that give the entire system its unprecedented scale. By leveraging digital tech like e-wallets, blockchain platforms, and instruments like cash waqf-linked sukuk, which, by the way, are essentially socially driven Islamic bonds, the system overcomes traditional geographic barriers and brings total, verifiable transparency to how funds are flowing. However, the researchers offer a very important warning here. Technology can streamline distribution and make things a whole lot faster, for sure, but it cannot replace the communal and spiritual dimensions of Islamic finance. Tech alone isn't a magic savior. It has to remain firmly grounded in the grassroots community trust that we saw back in Cluster A. Let's move to Section 3 and see how this builds into the TASBIH blueprint. So the source material actually synthesizes all 4 of these clusters we just discussed into a single operational architecture, one designed specifically to outcompete predatory digital lending. It's called the TASBIH model. TASBIH mathematically engineers a structural competitor to digital Riba across 3 seamlessly integrated layers. Layer 1 is the community layer. Instead of relying on cold digital algorithms, local mosques and Islamic boarding schools act as the foundational platform for trust and verification. Here, you don't need a high credit score. You just need positive community standing. Layer 2 is the institutional layer. This is where local microfinance co-ops step in as operators on the ground to distribute the funds safely, utilizing that first loss capital shield we unpacked earlier to protect their balance sheets. And Layer 3 is systemic. Regulators step in from the top down to ensure transparent public reporting, standardization of impact metrics, and long-term economic sustainability. Together, these 3 layers deliver all the speed and ease of digital apps, but without any of the exploitation. And this brilliantly illustrates the fundamental, paradigmatic shift we're talking about today. The contrast in ultimate goals is what truly matters here. The goal of digital Riba, or predatory lending, is purely to maximize the extraction of wealth from the poor. The entire business model only succeeds if you stay trapped in debt and keep paying that interest. But the goal of the TASBIH model is the complete opposite. It is to maximize the transformation of the poor into the self-reliant. Success in this system is measured by something entirely different. It's measured by when a borrower ultimately transforms from being a receiver of charity into a giver of charity. How amazing is that? Section 4, Redefining Poverty and Justice. So the core takeaway today is this. Exploiting the financially vulnerable is not, and never has been, a necessary evil. As the data from Akhuwat and the structural framework of the TASBIH blueprint show us, when we actively align communal trust with smart financial mechanics like first loss capital and digital transparency, we can actually build a system that heals rather than harms. So I want to leave you with this final provocative thought. If a financial system can be explicitly designed to transform borrowers rather than extract from them, and actually do so at a scale of hundreds of millions of dollars, what else about our modern economy needs rewriting? Thank you so much for joining me in this explainer. Keep questioning the systems around you, and I'll see you next time.